This iconic innerwear and athletic wear company is showing strong financial results but not getting any credit. Today, I'm talking about why Hanes brands could be significantly undervalued. All this and more coming up on Morris Money. Hello, welcome to Morris Money, where we give you stock tips in under 5 minutes. I'm your host, Morris Willie. Today, I'm talking about why Hanes brands could be an undervalued dividend player for your portfolio in the long term. Investors are witnessing carnage in innovation and disruption stocks, whether it's telemedicine, streaming, cloud, data analytics, or the always prevalent something as a service type stocks. Investors of all ages may be turning to less complex stories like food and clothing, which can often make solid long-term investments. One of these type of companies may be Hanes Brands, HBI, a leading producer of innerwear and athletic wear such as iconic brands such as Hanes, Champion, Maidenform, Playtex, and Bali. Innerwear is the industry term for clothing items such as underwear, bras, panties, t-shirts, and socks. And the company is the United States market share leader in that category. The majority of total company sales are through wholesale channels such as department stores or sporting goods stores. Approximately 17% of revenue is done through consumer direct channels such as its own stores or e-commerce websites. Walmart as a single customer represents about 17% of these total sales. Hanes Brands employs 61,000 people in 47 countries, with about 70% of sales coming from North America and the rest in various international markets. The company is best known for its advertising campaigns with basketball legend Michael Jordan, with whom it has a relationship going back over 30 years. The company was founded in 1901 and currently has a $4.7 billion market cap. In May 2021, the company announced its 3-year full potential growth plan ending in 2024, which is a series of initiatives and plans to drive incremental revenue growth by $1.2 billion and expand operating margins to 14.3%, since increased to 14.4%. Highlights of the plan include increasing the Champion athletic brand to sales of approximately $1 billion and reinvigorating innerwear to the tune of $200 million in incremental sales. Total company sales are expected to be $7.4 billion by 2024, but the company recently increased that target to $8 billion. The implementation of these goals centers around 5 key initiatives. The first is enhancing design and innovation to meet current consumer trends and needs. Next is supply chain segmentation, which increases efficiency and lowers logistics and operating costs across most segments. Another one is simplification of processes and management layers in order to make better and faster decisions. The company is also investing in data analytics and technologies that not only improve internal processes but also improves the e-commerce experience for customers. This plan is self-funded, and the company's investment is expected to be roughly $90 million in brand marketing, $40 million of depreciation related to growth-oriented capital investments, and $30 million for technology and people. Cumulative 3-year free cash flow from these initiatives is expected to total $1.6 billion. Now, let's discuss potential valuations. Analyst earnings per share estimates for the 2022 calendar year are $1.75, which puts the company's selling at only 7.8 times this year's earnings. The company's current enterprise value / EBITDA ratio is approximately 7 times based on EBITDA estimates of over $1 billion. The company rarely gets a high multiple as it is not in a sexy business, all jokes aside. Underwear is typically a replacement and population growth business that doesn't usually generate high growth rates. However, the company's full potential growth plan may change that dynamic. The average target price amongst analysts that follow the company is approximately $21, with a low of $18 and a high of $27. If we look at discounted cash flow, we could potentially see a valuation of $22 based on a discount rate of 10%, starting earnings of $1.80 per share and a 5% 10-year growth rate. The company is comfortable with its free cash flow and liquidity position and indicated its plan on buying back shares in the first quarter of 2022. Lastly, the company's dividend yield is currently over 4% with a payout ratio of only 33%. In conclusion, Hanes Brands appears to be undervalued at this time, as investors are not giving it credit for potentially higher growth and a steady return of capital to shareholders. If the company reaches its full potential goals by 2024, it could definitely be a great brand for your portfolio. But let me know what you think below about Hanes. I have a position of Hanes within my portfolio, and I've been adding to it steadily with majority of the names in my portfolio as the market's been beating it down, and Hanes at $12 seems like a great deal to me. But let me know what you think below about the Hanes company. Please don't take this video as financial advice, and thank you for watching Morris Money.